Hi everyone. Today let's talk about the latest CPI report. So of course, if you've been watching the markets, you saw the CPI report came out in the pre-market on Friday and everything went down. Then of course I'll do my technical analysis on the QQQ, take a look at the VIX, we'll also touch on TLT, as well as the 10-year yield for US Treasuries, and then we'll finish up here with oil, or oil futures. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this as well as whole portfolio overviews every single week, so make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So the CPI report came out even higher than expected. It was expected to be pretty high at 8.3%, and it came out at 8.6%, which of course was not good for equities. They say with the pickup in CPI inflation rate, pretty much all included in the food and energy sector, the month-over-month core inflation was 0.6, which is a pretty sharp month-over-month growth, and car prices again began to rise. So if you've been watching, we've been talking about all the different things that are causing this, to include supply chain shortages, as well as specifically for cars, the chip shortage. Analysts from around the world are saying that they are definitely concerned with inflation picking back up, and that there are no pockets of weakness in this report. They do mention that in their view, this is no longer just a supply chain disruption. Inflation is also being driven by strong consumer demand in a red-hot market, along with strong wage inflation. They say this basically cemented the fact that we are going to see 50 basis point hikes throughout the summer and potentially into the fall, depending on what the Fed is seeing and how inflation is either continuing or if inflation has turned down during the fall. Another analyst says not only was the CPI ugly, and higher than expected on almost all fronts, the decline from inflation could be slow and painful. And yet another analyst, a little bit more focused on housing, is saying that home purchases have rocketed and renters have little choice but to continue to accept steeper and steeper rents. Basically, from top to bottom, this report was pretty difficult and the market responded in tow. Despite that, I do think this down move here in the QQQs was pretty aggressive. The last 2 days of the week were a total of around 6% of downside, pretty aggressive in the down move. But we did stop right at support, so there's a little bit of optimism potentially. If we do get a nice double bottoming formation here, between these two sections, if we complete like a full W here, and we could potentially get a nice little move up. I'm not fully convinced that this CPI report was completely out of the blue and that we haven't priced in a lot of this pretty negative news and pretty negative expectations from the Fed. I mean, over the last month, we're still down quite a bit, around 30%. And this last little 6% down move, I'm not sure means that we're going to continue down and break through these next levels of resistance, especially in the short term here, where you see a pretty strong separation between the 9 EMA and current price. The 9 EMA still sitting at around 305 and price sitting around 208. That's pretty steep difference. Similarly to what we saw here on May 18th, 19th, and 20, where we got pretty separated and then we saw that nice little retracement. Again, here we had moves down here on April 21st and 22nd. Still got some separation and then we got a little bit of a retrace before we continued down. So anytime we get a little too extended here from price, even to the upside here, you could argue maybe on 27 May, we expected to go at least sideways until the 9 EMA caught up. And potentially here, we could expect a move back up to maybe 296 or 297 and allow that 9 EMA to catch back up. If we do get a nice double bottoming formation with a really solid bounce, then I would argue that we were going to move back up to maybe this 320 range, back into this more normalized trading range, and then I would expect a rejection and a continuation down, at least to retest these lows and maybe to continue down into the next level of support around 265. Moving over here to the VIX. In my last week's video, I did mention we could get support around this 144 EMA, which is basically what happened. We dipped slightly below it and then we had a nice little move up. You can see we still do have some short-term resistance right here at 2850. And we did bounce off of that. Not to say that this is going to hold, but it could potentially push us lower. And if we do get that push down, I would expect a move down to around 23. If we do get that move to 23, I would expect equities to rally into that point, at which point we would find support and continue higher, and we should expect the equity markets to continue down. Next up, we have TLT here on the daily chart. As I mentioned, we still have this really strong downtrend happening, but some really solid support, and it did hold last week. Still currently at that 113.77 range, and I do expect this to bounce off. And if we do see a nice little bounce in TLT, that should cause interest rates to at least cool off a little bit, allowing for the QQQs to rally also. And just to see what that looks like, we do have the 10-year yield charted out here. You can see it's currently at just over 3.15%, and this has been a big rally from around 0.5% all the way up to 3%, many hundreds of percentage points of rally, currently up around 517%, super aggressive, and you can see this is putting us way back into that trading range, maybe even slightly above where we are in the general history for the 10-year yield. And my point here is that this is getting a little extended. This last run was really aggressive at 84% in and of itself. See a little bit closer what that looks like here. Big bounce off of really strong support, retested off resistance, found support at a higher low, and then continued up higher. Now this certainly could be a breakout. We could continue higher, maybe up to that 3.5% range. Seems pretty strong. We do have some pretty decent resistance here at 3.25%. Maybe that's where we're going to go, just touch that 3.25% and then potentially move down from there. But this is really extended. Obviously, we had the big down move for COVID when rates got really low. We've since retraced all of that and continued higher, which obviously is difficult for the QQQs. But in my opinion, this is extended. If we see a nice bounce off of 3.25, maybe 3.5, that should spell a bottom for the Qs. Lastly here, I do want to talk about light sweet crude. You can see just how extended this move is, going from super negative when oil went negative back on April 20th, which is pretty close to the bottom of the market for COVID. And since then, it's rallied super aggressively all the way up from well below zero, all the way to 119. You can see we're currently above that resistance point, and it looks like we might be topping at that previous sign of resistance here at the beginning of March. If we do get a nice little retracement, maybe a move back down to this 144 EMA around $95 a barrel, that should certainly improve the economy as a whole. I know that energy is not included in the CPI, but energy always affects a lot of different sectors within the CPI. So if we do see energy prices cheapen at least slightly, there's potential that we could see a slowdown in CPI, which would make the environment significantly stronger for growth stocks and the QQQs. So keep that in mind as we go forward. The downtrend is still alive, but we are currently at support, and there are some charts that look pretty extended. And I wouldn't be surprised if we saw a down move in some of the charts like oil, which could potentially prop up stocks like the QQQ. Of course, as we were filming this, the futures market opened. You can see the NASDAQ futures are down already 143 or 40 points or so. So down around 1% at the open. And it certainly looks pretty rough here. You can see on the 2-hour chart, we're just continuing this big down move. Take a look at that on the daily chart. You can see still decently within the trading range, somewhere around those lows that we had here in May. Still haven't broken those lows fully, potentially at the tails of these wicks here, continuing downwards, and certainly some more downward potential, maybe even lower to that 11,200 range, which would be a pretty significant move from where we are now. Otherwise in progress, big down move along with the rest of the markets. You can see I lost quite a bit of money. I was somewhere around 13,000 down, and now we're back to around 17, which is where I was previously at the market lows. So pretty much moving with the markets right now. And you can see I'm positioned pretty long going into the weekend. Didn't really mean to do that, but the market continued down more than I thought it was going to, so that's unfortunate. We'll see how this plays out on Monday. Really hoping for a little bit of a pop, but the futures seem to be down a little bit, which is not really good for me. Let me know down in the comment section what you think. Is this market just going to go down forever? Is this market just going to go down forever, or is there a potential bottoming formation and a slowdown in inflation? Definitely like and subscribe if you got any value out of this video, and hit the bell so you don't miss out on any future videos. Of course, none of this is financial advice. This is all for entertainment purposes, and good luck on your trading, and have a great day.